G'day there viewers, and welcome to a new unit. We're looking at Introduction to Costing. We're following Osborne Books. Today we're looking at the costing system. So we're looking at the overall costing system. So let's get started. These are objectives for today. We're going to look at the purpose of costing. We're going to look at some cost information. We're going to look at financial versus management accounts. We're going to look at ascertaining some costs. We're going to look at classifying costs, that should say. And then we're going to have a look at a comprehensive example. So, the purpose of costing. So, costing enables you to work out the cost of a unit of product or service that you're selling. And costing is used by managers for decision making, planning and control. It's basically used to produce statements which managers can use. Cost information. Cost information can be used to help determine the selling price. For example, cost price pricing. So, for example, if something costs 50 quid and then you put a margin of 10%, or 10% of 50 quid is £5, so the selling price will be £55. So this is a simple way to use cost price pricing. We're going to come on to margin as well, so I'm going to look at that in subsequent units, but cost plus is a little bit more simple than margin, but they're both similar concepts. Valuing inventory. So that the stock so you can use cost information to work out the value of the stock that is held by the organization. You can use it to provide information for financial statements, e.g. how much to buy and sell by. Here we're talking about financial statements that are used by the managers. So a costing system is used by an organization to collect cost information that can be used for decision making, planning and control. We've already seen that. You're going to see that over and over again in management accounting, decision making, planning and control. They're the most important concepts in management accounting. The costing system organization chooses the way that it presents this information. There's no legal basis, whereas in financial accounting there is a legal basis. So for management accounting, you can produce your statements however you like, whereas financial accounting, you have to produce them in a set format. So cost classification. Costing classification is basically collecting the cost into whatever kind of unit or product that you buy or sell. It can be a service or a product. So for example, Coca-Cola is a product-based service. So the classification of the costs will be by product, whereas a hospital is rather different. It could be by patients, it could be by beds, depends on the actual way that the business wants to classify its costs. Costing is part of a wider wider accounting area called management accounting. So management accounting is basically internal statements that are used by the business, whereas financial accounts are produced for external, but they can be used by managers as well. So financial accounting versus management accounting. So financial accounting is concerned with the historical transactions, record keeping, and preparation of financial statements. So you saw in bookkeeping 1, if you've done bookkeeping 1 yet, that the costs are, so if you purchase something, if you pay out wages, then these transactions, are recorded in your accounting system. Then your accounting system will get the balances of all the transactions that you had and then produce a trial balance, and this trial balance is taken forward to produce financial statements. You haven't seen the production of financial statements yet, but you will see them as we go along. Management accounting is about planning future costs and so that decisions can be made, and it's also about controlling those costs. So you're going to see budget versus actual quite a lot. So this is what we budgeted for, this is what we planned for, and this is what it actually costs. And then you're going to come up with some kind of explanation why there's a difference, if there is a difference, a significant difference that is. So financial accounting features. So financial accounting, as we had said again, is recording historical transactions. It's accurate to the nearest penny. Obviously, if you're producing information for taxes, then it should be very accurate, because the taxman will chase you if it's not. Management accounting features analyzes information to make estimates and future predictions. So management accounting doesn't have to be as accurate to the nearest penny. You can make estimations and predictions, and you can have different sets of scenarios, for example, is a feature of management accounting, whereas with financial accounting, you wouldn't see scenario-based analysis or anything like that, because obviously it's based on actual information, it's historical information. So it looks in detail at costs of sales, income and products and services. You may use estimates, we've already been through that. Products provides reports for management, ideal for internal decision making. So financial accounting data comes from the ledgers, so we've already been through that. So the ledgers, remember, are the books of the accounts, and you're recording all the transactions as they go along of financial documents, and the transactions, and then these are taken to the trial balance. So all the list of all the balances in all the little T accounts that you've got from the ledgers, and you'll produce a kind of financial statement from that. Let's carry on. Well, not kind of financial statement, it will be a financial statement. Detail. So you can find details for your management accounting information by looking at source documents, by looking at information in your financial accounts, and then using that information, labour, so your labour, wages that you paid. So you can use all this information to actually plan for your future. So you can use your historical costs to plan for your future. So yeah, this is something which businesses do, and it's not really expected, because you can do it in other ways as well, but normally this is the way that a business does it. It's a way of quickly ascertaining cost information and then using that to predict future costs. Current and future costs. If a business wants to go to find the cost of material, they can look at purchase orders, they can look at quotations, they can look at the wages that were paid out, they can use out what suppliers are looking to pay, like suppliers pricing list, they can look at rental costs, so all of these things. So it's a question, are you expecting a pay rise? So obviously the reason for this is forecasting. So for example, if you are expecting a pay rise, normally every year people get pay rises of around 1 or 2% nowadays. You know, historically it's been more, 4 or 5% sometimes even 10%, maybe even you know, I received the pay rise once of you know, a fifth of my salary. So when I got a promotion. So are you expecting a pay rise? This is more talking about inflationary rises. So the 1 and 2%. So you have to factor that in, because everyone is going to get paid 1 or 2% more next year. So you have to put that into your budget and then see what it looks like. And if it's more or less, then you have to when you actually get to that point, then you have to come up with some kind of explanation. Maybe you forecasted incorrectly and people got more than 1%. Classifying cost and income. Okay, we're going to leave it there for now, and then we'll come to this in the next lesson. So thank you for listening. I'll see you in the next lesson.